Jaya, and now you can take it forward.
Thank you, Divakar. And at the outset, I would just like to express my sincere thanks to all of you for giving ICICI Prudential AMC this opportunity to explain equity market outlook and also a few products if time permits. And, and also for your interest in the program. We are delighted to explain the market dynamics based on ICICI Prudential AMC's fund communication. And I'm going to take you through all that. While, this presentation was released in the month of June and pertains to, data points at few places on macros related to 31st May releases. But I am going to update all of you till the 30th of June. That means the entire June month developments. And we are going to learn about, what has changed in June month and how the overall, investment ecosystem is looking like and what are we communicating and reiterating to the investors. So this is going to be the agenda that we have, for the next hour and a half. Will that be okay, including your Q&A, Divakar?
Yeah, if you can. Yeah. So I think 1 hour is good enough.
Yeah, thank you so much. So I welcome you all and wish to express my sincere thanks once again. Let's get started. So, if I, instead of taking you through each and every slide from here, after explaining what has changed in the last 1 month, I will, take you through ICICI Prudential AMC's framework of understanding equity through equity valuation index guide. And there we understand the valuations in the market, we understand the business cycle environment, and also the near-term and long-term triggers that can give new direction to the market, and also how the sentiments are shaping up. So it's a four-facet analysis or understanding of the markets. That's our approach of communicating with our investors on the outlook. So if I just explain this to you, what has happened, this slide pertains to, if you can just see, this pertains to June month development, where you can see Nifty Sensex May month development, end of the May. So Nifty Sensex returns are showcased as 2%. So we have not rounded it off. It was 2.5 for the month of May. And as you know, we have seen such a remarkable start to Q2 of calendar year 23 or the new fiscal 24. What a start! April, May, June months put together. That means the 3-month view. Here you can see only May month what the markets have delivered. Nifty Sensex, it's showing 2 because we have not considered 2.5 as say rounding it off to 3 or little higher number, but showcase that as 2. If you just look back, a month before, Nifty Sensex posted around 5, and June month, if you see, it was even higher. So now, if I just see what Q2 returns have been for Indian frontline indices Nifty and Sensex, you will see that in Q1 of 24 fiscal or Q2 of calendar year 23, markets have delivered 10% return. I'm not including last 3 days rally or last 2 days rally, but I'm only considering till 30th of June. So till 30th of June, in the first quarter, you will see that Nifty Sensex returns have been 10%, and the markets have bounced back in style after prolonged negative returns from November 2022 till March 2023. So if you see Q1 of calendar year 23, that time Nifty was down 4.6%. because at that time there was huge FII outflow. So you can say that Q1 of new fiscal has indeed been very, very good. And you can see the reasons highlighted here: strong economic activity, well curtailed inflation, and renewed interest by foreign investors have boded well for Indian markets. However, I just wish to also tell you that this rally has begun just in last 3 months. If you just compare ourselves with other parts of the world, how much they have delivered, like Japan in the month of May has been shown at 7%. But I wish to tell you that in H1 of 23, that means from January till June, Nikkei has posted, Japanese index has posted close to 30% returns. And if you track, the returns posted by, say, US index, like your NASDAQ 100 index, that has also posted close to 30% return in the first 6 months of calendar year 23. And if you check for Standard & Poor index of US, that is around 16%. If you check for DAX and CAC, that means the France and also, the German markets, Germany and France were, negative in the month of May. It was because European Central Bank had hiked the interest rates in the month of May because of the fact that, they were, going through a very high inflation scenario, and they started raising the rates later than other parts of the world. So they hiked the rates, and therefore, we have seen, the impact of slowdown or estimation of slowdown resulting into underperformance in the month of May. However, if you track for first 6 months of calendar year 23, you will find that German markets have posted around plus 15% return, and likewise, the markets in France has been around 13%. Now, our comparison, these are the developed nations, so they have done far, far better than us in the first 6 months. But when we compare ourselves with, say, our Asian peers like Taiwan market or Brazil or China for that matter, compared to our emerging market peers also, you can say that India is just playing catch up after outperformance in 2022, but underperformance starting from November end 2022 or December 22 till March 23. So after posting plus 5% in 22, where other markets were deep in negative like minus 30, minus 20, we have seen the tide changing from calendar year 23. For other parts of the world, developed markets have been doing extremely well in terms of their market performance. And when we compare ourselves with, say, Brazilian market, in the month of May, it is showing 4% up, but in first 6 months of this calendar year, Brazil market is up by 10%. If you check for Korean markets, it is up by 15%. Taiwan is up by around 20%. In the first 6 months. So compared to developed nations and also compared to our emerging peers, India has just started, we can say, despite the fact that we have the best of the market dynamics and economic parameters right now favoring us, despite all that, we have seen a late start now in 2023, but what we say is, whenever it rains, it pours. So it seems like market is in that kind of mood, and the reasons are also there. But while we can rejoice or celebrate this this bouncing back of markets after a lull, we need to also be cognizant of certain facts that I'm going to take you through. But other slides, as you see, on what each sector has posted. So this data, because this is the latest available presentation, Here you can see for the month of May, but I can just tell you that June month was spectacular for all the sectors. All sectors were in the green, and what you can understand in Q2 of calendar year 23 or first quarter of 24 is that there has been a broad-based recovery with all the sectors participating in that rally, and across market capitalization you are seeing that participation, not just restricted to select few or not a narrow rally. What you can see is that the growth sentiment and the positivity in the Indian markets due to about Indian economy is going very, very strong and positive, and as a result of that we have seen mid and small caps taking big lead from the large caps in the last 3 months. So in the last 3 months, if you have seen, I've told you that in the first 3 months of this calendar year, large caps were -4.5, and April, May, June, they were +10. So April, May, June for mid cap and small cap was even higher, ranging between 16 to 17%. So mid and small caps returns in the last 3 months have been spectacular, and they have beaten large caps by a decent margin. And what this shows is that there is a broad-based participation in the market, not restricted to just one sector or one particular market cap business. Across it is happening, and this is something which is very good. It is giving, a good breadth to the markets as far as participation is concerned. Now, why we need to also rejoice and understand that this is actually a very good phase for Indian markets. If you just see our robust financial sector and a very healthy corporate sector, our continued fiscal policy thrust on the quality of government expenditure, and now the new growth opportunities stemming from the global realignment of the supply chains. Other than that, Indian macros have never been that good. What we are seeing right now, whether it is inflation cooling in the last 3 months, or current account and fiscal deficit dynamics improving, or the weak global demand weighing down on commodity prices some time back, leading to favorable dynamics for manufacturing units where the cost comes down, whether it is oil or metals. And the supply constraints that we witnessed since the start of pandemic and its continuity even after Russia-Ukraine war, we have seen that those supply constraints are behind, liquidity is ample. Now, what else to say? From all quarters, it's like it's inundated with such good news on macro stability. So this is the situation we are in currently, and therefore, in this particular presentation, our company has actually compared how our macros are in the current environment vis-a-vis how we were at the end of, or in 2013, when the Fed had actually indicated the end of quantitative easing that started from 2008 global crisis. So at that time also the Fed had indicated tapering of the measures taken. And the same thing Fed did in 2022, where it started hiking interest rates tremendously. So how we are better off, that we have showcased, and you can see inflation data because this presentation is released in the month of June, and inflation data comes with a lag effect of 1 month. So, what you see is the data projected for, so April data comes in May, and then that gets presented in June month, monthly market outlook. But I will just update you on that April, May, June inflation prints 5.7, 4.6 and 4.2 for India, much lower than RBI's comfortable upper limit of 6%. So last fiscal, RBI's comfortable zone was 6%. RBI has started accepting 6% after Russia-Ukraine war led to high inflationary environment world over. Otherwise, RBI wants 4% inflation to prevail in India on long-term basis. But it accepted upper limit of tolerance given the unprecedented situation we were in. However, we ended the year 22-23 on a slightly higher inflation data at 6.5, averaging at 6.5 compared to 6% that was desired. But the new fiscal that you see, the 3 months inflation prints have been indeed much below RBI's targeted zone of 6%, and we are at 5.6, then 4.6, then around 4.2 as per the latest release. So the inflation is falling, whereas in this scenario, we have compared this when the Fed indicated that it would curb inflation by steeply hiking the rate. So how our markets reacted. So, so you can see big difference in 2013, when the Fed had indicated its desire to stop quantitative easing. At that time inflation was very high in India. At that time oil was $120 a barrel, deficits were very high, but this time around it's much better. At that time, with the announcement, our markets had fallen 9% immediately within 2 months. But here this time, when this was announced by the Fed, that its intention to hike the rate, even RBI started rate hike, in line with the other central banks in all parts of the world. So you have seen opposite reaction in terms of market development. It was +7. I come to this yield part on the debt side. If you check for currency movement in 2013, our currency reacted quite negatively and rupee fell drastically, but this time around it fell by a lesser extent, because in 2022, remember, Fed started hiking rates from 2022 onwards, and unprecedented and steep hikes, frequent hikes Fed has done, and 0 to 0.25% interest rate has now been brought to 5 to 5.25. So 5% hike in 10 tranches. That was very fast, very steep, unprecedented, never seen in the last so many years, decades rather, because America had not witnessed such high inflation in the last 4 decades. So inflation touched 9.1 in April 22 in America, and from there on they started curbing inflation by hiking the rates immensely. So when Fed started hiking rates, the money started flowing out of emerging markets like India and moved to US, because even holding US treasuries, you got 4.5% kind of returns, and dollar appreciated from 100 to 115 within a short time span. So by just holding the dollar assets, the safe haven, the safe haven appeal of dollar, and the fact that it generated almost 19% return by just holding it, was a good reason for a risk-off trade at that point in time, where money flew to US. So at that time, despite the fact that every month there was huge outflow, because the domestic flows remained robust, the markets and the currency depreciation was contained. If you just check forex reserves, what the forex reserves were in 2013, at that time we were just 291, and as I'm talking to you, at the end of June, the numbers reported have been $590 billion, close to that number. That is our forex reserve. And I want to tell you that before Russia-Ukraine war broke out, we touched an all-time high of $635 billion forex reserves. And after that, we have seen in the year 2022, foreigners had withdrawn 1,21,000 crores out of Indian markets. And, that led to dwindling of little, to some extent, the forex reserves, but still it is at a great level, 590 at the end of June. Now, if you check for other positives about Indian economy, the strength of Indian economy, you will find that Indian corporates balance sheet is much stronger and better now. The debt as a percentage of GDP has been falling because, as you know, corporate India has got tax advantage because Indian government has reduced the tax rates from 35% to 25% net effective tax rate from September 19 onwards. So low tax and interest rates remained subdued from February 19 till March 22. That was 3-year phase when RBI kept cutting the rates and maintained soft policy of interest rates, which benefited corporate India very, very well. And during that phase, pandemic had broken out, and that resulted in very low commodity prices and very low oil prices because everything was shut and there was very low demand. Due to that, the operating cost, the manufacturing cost, and the financial costs of running the business went down, and the corporate profitability improved. And as corporate profitability improved, the companies started paying back to the providers of money, that is banks and financial institutions, and that resulted in their debt as a percentage of GDP. It is expressed in this slide. Debt numbers falling and corporate balance sheet improving, even banks balance sheet improving because they got back money from the companies. And in this phase, you can see when the companies were repaying, you can see there were more upgrades happening compared to the downgrades, which was a sign of very good, scenario. But overall, if you see in 2022, since the time the rates have been hiked, our RBI hiked it 7 times and brought repo rate from 4% prevailing in March 22 to 6.5 now. So 2.5% has been hiked in 7 tranches, whereas Fed has hiked 5% in 10 tranches. If you check for other central banks like UK, they have also hiked it very recently in June month by 50 basis points and brought the rate to 5%. And likewise, European Central Bank has also been hiking rates because they have still fighting inflation. But India's fight against inflation seems to be under control. So if you see this, there were more upgrades till this time, but as the rates started going higher, it impacts interest rate sensitive sectors and their ability to pay back. So therefore, in this period, there were a few downgrades also because certain businesses are sensitive to interest rate hike, and therefore some downgrades were also observed during this phase. So this is the data on the non-performing assets of banks, and you can see fall in the trends. And you can see Indian households also as a percentage of, what you call their overall, ability to borrow from markets and borrow from banks and financial institutions, gets reflected in many data related to personal loan, offtake from banks to Indian households in terms of, home loans and personal loans. But the fact that, Indian households are also less debt laden. We are conservative people, and we also don't want our balance sheets to, get disrupted due to heavy debt. So whether it is Indian companies or Indian banks or Indian government for that matter, and Indian households, we are lower on debt, and that is a good thing. That gives a lot of comfort to foreigners when it comes to understanding the prospects of Indian markets as an investment destination or Indian economy as an investment destination. If you look for the revenue collection, Government of India's revenue collection has been growing immensely. Earlier, until 2021, government used to strive to achieve 1 lakh crore collection every month. And now it's like 1.5 lakh crore is a given thing. Soon, I think we will see a new, target of 2 lakh crore at least every month, because The latest numbers we have seen 1.6 lakh crore, and before that also the highest was noticed was around 1.8, close to 1.8 lakh crores. So 1.5 lakh mark has been crossed, and continually government is able to collect good revenues. At the same time, the government, as I mentioned to you, there is a continued fiscal policy thrust on the quality of government expenditure. So government is cutting down on wasteful expenditure, and it is basically, improving countries' infrastructure and spending there, which creates jobs for youth and also assets for the country. So as a result of that, Government of India's fiscal deficit as a percentage of GDP has not ballooned. Whereas if we compare other parts of the world, there what has happened, because their stimulus was many-fold times higher than us and they printed money, that led to exorbitantly high level of inflation and huge debt on their balance sheet, whether it is US or UK or Eurozone for that matter, or Japan. They were printing money, and therefore that led to unprecedented high levels of inflation. In case of India, our government chose to distribute grain rather than printing money and giving cash in the hands. Cash was transferred to the needy and the farmers, who needed that under Prime Minister's, welfare schemes, and they were the direct beneficiaries of that. And it was to such an extent which continued their comfortable living, and at least, they were able to sail through that worst phase that world has witnessed, and at the same time, it did not lead to high inflation. So Government of India's balance sheet is also under control, and the deficit is under manageable, you can say. Collection of tax is very good. If you see FDI and FII flow, now this is something that, despite the fact that, we say our macros are very strong and inflation has cooled down and current account deficits and fiscal deficits have improved, and commodity prices were low, oil was very favorable for us for the last 1 year, and therefore, overall it helped us, and supply constraints were also behind. All that is given. But we can't deny the fact that our markets cheer when when there is good flows coming from foreign money, foreign institutional investors, and FDI money. So if you see this red trend line, it is showing the trends of foreign flows in 22, when Fed was hiking rates and other parts of the world they're hiking rates. At that time, there was risk of trade. From emerging markets, money went out. From India, 1,21,000 crore went out. So this was the trend. But then you see in 2023, from April, rather, last fortnight of February onwards, in January month, there was huge outflow for 23 foreign money. 29,000 crore went out. In February month, in the first 15 days, money went out, but last 15 days it came back, and therefore the total outflow was closer to 6,000 crores. Overall, you can say close to 35,000 crore went out in Jan and Feb. But after that, March, April, May, June, and June was such a month where we have seen such good flows, foreign money. Some 52,000 crores were invested till 30th June. In the month of June by FIIs, and if you go back to May month, foreign FII money was to the extent of 44,000 crores in Indian market, but June was even better, and July has seen such a good start where already, in the last 2 days, very good flows have come. So what we are seeing is that, markets rejoice when we see good flows coming from foreign money. So FII money FIIs have now turned their face to India after staying away for more than a year in 22 and 22-23 fiscal. Now they are back with a bang. And if you see FDI flows also got impacted, compared to what FDI flows were in 21-22 fiscal. Compared to 21-22, 22-23 was So you can see this upper trend line in 21-22 and 22-23 it went down. However, after the recent visit of Prime Minister and other delegation of business, we are seeing, we are hoping that now it is going to see a good pickup. And one more thing that we need to understand that not just Indian macros are all-time best, or compared to the scenario we are in, very good compared to other parts of the world. So on relative basis, we can certainly say that we are far superior. But there are other reasons also for this strong inflows that that are coming to Indian markets, and for that we can understand that FIIs are also retreating from China. And what we hear that China plus one is a theme not just in manufacturing, but it is also evident in flows of foreign money coming to India. China reopened its economy in November 22, and for a short time period, FIIs moved to China, and lot of flows which went away from India moved to China, because valuation wise China was very cheap. And obviously, China has a very good infrastructure and other prospects of, exporting to the world. But because of their, the government policies out there and the developments that have taken place from 2020 onwards, the world is actually shifting from China to other parts of the world, including India. So it's not that India is the only beneficiary. We are seeing other parts of the world also being beneficiary of that. So for example, if you see, this chart where imports from India and China are showcased. So imports from India to the US has seen an increase, and from China it is falling. And I want to just also highlight that very recently US has passed Chips and Science Act, which is actually aimed at constraining the development of China's semiconductor chip industry. So now the US government is considering restrictions on US investments in China. And in the G7 summit also, it was reiterated that there was an intention to de-risk from China. So whether we track some of the pension money flows, or we track some venture capital money, or for that matter the asset management companies, the big ones, and the sovereign wealth funds, all of them have slowed their pace of direct investments in China. And Warren Buffett also made news after he sold 50% stake in one of the Chinese big electric car group. And as a result of all that, what we are seeing is that there is some kind of de-risking, that de-risking from China is benefiting India, one can say. And therefore, other than India, Korea, Vietnam, and our Indonesia and other peers, India has also, if India benefits with this increased trade, definitely, it is going to give a boost to the exports. And you can say not just China plus one, theme in manufacturing, but in foreign flows as well. So our exports have improved, and as I explained to you, corporate profitability has improved, very healthy. It is because, as you know, during pandemic period for almost 2 years, oil remained between $25 to $45 a barrel price on an average in that space. Only from 21 onwards, late half 21, past 21, it started going up gradually. And later on, India decided to source its oil from 27 different countries and not rely on only one. So oil remained very, very favorable for India, even during times when oil prices in 22 touched $135 a barrel price in the international markets. And we tied up with Russia and other countries, and we got it at on an average around $60 a barrel price, and that resulted in reducing our deficits and at the same time inflation. And it lowers the cost for companies because oil is an essential ingredient in the manufacturing of the products. So oil prices were favorable, raw material prices were very, very favorable in pandemic period 2020. At that time, low sourcing, low cost, and then all were working from home. So other operating expenses like rent rate, taxes, salaries, electricity bill, traveling, advertising expenses, all these were curbed. And as I mentioned to you, Government of India also reduced tax rates and RBI was cutting rates, interest rates, all benefited Indian corporate profitability. And I can tell you from June 2020 till June 23, this 3-year phase, quarter by quarter, corporate India is showcasing robust performances and earnings growth still continues to remain in teens. And that is something which is like very good about Indian companies, which shows this fundamentally it is growing, or it is showcasing strength and not something outwardly. So this is about that. And demographics are also favorable for India. Working population on an average is 29 years. Whereas in other parts of the world like US, Euro, or Japan or China, what we see is the working population is on a higher side. Now coming to the most important aspects, valuation wise, I'll come to this slide, but before that, let me just take you through this. And one more thing about what we are seeing is that US economy is very, very resilient. And what we see is the market reacts very fast to any development on US taking place. So it was believed that after 5% rate hike done steeply in the US, the US would actually go into shallow recession. But as we are seeing the data, like the data on the GDP growth rate that was released some time back, and the labor market data, all that is suggesting that it's not gone into recession. But today only the data for the PMI manufacturing has been released for US, for China, and for all markets. So India continues to shine with 57 plus reading. Any number above 50 shows expansion, and numbers below 50 means contraction. So when we check for US or other parts of the world, it is between 45, 47, 46, but India is 57. While we have just fallen, from 58 to 57 in this month, but still it is very good. So overall, what we are seeing is that in the US, some of the data points suggest that the recession is not likely to happen now. Maybe it can happen after 6 months or 7 months if Fed hikes rate, because Fed has given some different statement of late. So about that we'll discuss shortly in the debt part, but let us quickly understand this. Now this is ICICI Prudential AMC's Equity Valuation Index Guide, which takes into consideration 4 parameters of valuation: price to earning, price to book value, market cap to GDP, and yield gap ratio. And all the 4 ratios are given 25, 25, 25, 25 weightage. And the composite score is plotted on the y-axis. So at the end of May, this composite score was 108.8. And as I told you, in the month of May, we have seen Indian markets like Nifty and Sensex, posting very good returns for 1 month, mid caps, small caps, Nifty, Sensex. So this 108.8 is like 111 at least, and when in a day or two, when the new presentation is distribution and in so it is likely to be around 111 plus, because month of June has been extremely good for the markets. So what we see is, this is showcasing that we are in a neutral state at the end of May, and also at the end of June we are going to be in this state only, the middle one, where the fresh allocation in equity cannot be avoided even now, because the macros and other factors are so favorable. But at the same time, as I mentioned to you, Q1 of new fiscal has been very impressive. So what we are seeing is that valuations compared to before have once again risen, and as a result of that, if an investor comes new in equities, so we cannot also suggest to remain highly overweight on equity. So it's a neutral stance, and better way to participate in equity is through long-term SIPs according to your goals, and follow time-tested principles of STPs and SWP also, if you want some regular cash flows in these markets where we have seen in the last 3 months some good performance coming in. But as I mentioned to you, depending on what time you are comparing our return vis-a-vis other market returns, so we have a long way to go in future on the back of strength of economic data, because now we don't have something like huge stimulus of RBI or government of India, or huge stimulus of foreign money, foreign countries. But still, the good part is that there is disenchantment with China, and as a result of that, India is benefiting, whether it is in trade or in flows. And because if we track the data on China, there we see a lot of stress, whether it is their data on still that means the economic data remains lackluster there, and China is the only economy which is continuing with stimulus, cutting rates and providing stimulus now to bring back growth at a high pace. Now I will just tell you that at the end of May, composite score is in this yellow shaded portion, which as I mentioned to you, tells you that neither we can avoid because of such favorable dynamics, nor can we suggest investors to remain highly overweight because of the valuation and other risks arising out of global political scenarios are concerned. Therefore, we recommend long-term SIPs, STPs, and even SWP for regular withdrawals. If at all someone has participated in the rally, that would also be a good way to slowly book profits and at the same time continue staying in markets. That can also be suggested to those who need more income to run their day-to-day expenses. Other than that, let's trace back to this period. This is 2020. At that time, composite score was 70, in 70s. So it was very cheap, all the 4 valuation parameters. So the message was very clear for investors to aggressively invest in equities that time. And when the score you find is between 70 to 90, that is also a reasonably good level to put money in equity increasingly. But after that, you see in the mid zone, it indicates that it is neither expensive nor cheap, like in current scenario. So it's on relative basis, we can just say that, okay, other markets had fallen drastically last year. So compared to them, we were relatively highly priced. But look at our macro environment, macro dynamics, all the macro indicators are so strong, and therefore the market is commanding that privilege. So in that phase, when we indicated to investors to put more money in equity aggressively, you see here, at that time, nobody had any inkling of central bank favorable policies or government's favorable policies. Look at this unprecedented run for 1.5 years. from April 20 till October 21, this unprecedented rally in the markets on the back of huge liquidity coming to Indian markets due to excess stimulus given worldwide, abundance of liquidity in other parts of the world and also in India, and risk on trade at that time. So money flowed to emerging markets and India benefited. And other than that, there was the data that we have seen. Corporate profitability numbers started improving, and now July is a month where we will see the results of Q1 of this new fiscal getting released, and it is very likely that the markets will take cues from these data points that are likely to remain robust, on the back of good performances that is expected. Let's see, how the data for Q1 comes up. When it comes up from the second week of from 10th onwards, after 10th. So for Q1 data, so market will take cues from there. So what happened after October 21? From October 21, all the measures that were taken to provide stimulus were taken back in calibrated steps, and we saw from October 21 till March 23, for 1.5 years, there was -5 given by the market. In this phase, there was unilateral upside for 1.5 years, and this was from October 21 till March 23, there was fall of -5 in the market. And if you take April, our markets delivered around +5. So it neutralized, almost all kind of neutralized everything. In May month, markets have given 2.5. In June month, you can say around 3.5 or 4. So 3.5 plus 2.5, that means around 6, we can say 6% returns we have seen in the last 21 months. If we track from this period, October 21 till date. So till March 23, it was -5. And from April, May, June, it turned positive, +10. So you can see we are +5 or +6 till the end of June. So we can't say that we have generated huge returns or something like that. But obviously, there are companies which have done very well in this phase, but we are tracking from this time onwards. So it's like from this time to that time. That's the comparison. Not that in the last 2-3 years you did not make returns, but that we will showcase in some other data. So this is the situation, and you can see when we were touching the all-time high, 63,000 mark we touched in Sensex crossed in 21 October, and it took 21 months for Sensex to march past that high and to reach a level that we are witnessing right now. So 21 months wait is long wait, and therefore this is a moment to rejoice after such a long wait. We can certainly say that, but at the same time we don't have to lose our guard about the external environment, which can be sometimes favorable, sometimes unfavorable, because we have Fed policy. The Fed has indicated its intentions to hike rates 2 times in this year, and rate cut is in the offing only in 24. RBI governor is maintaining status quo on interest rates for the last 2 months, last 2 times. But no indication of rate cut in 23, but that is likely to happen in 24 only. So there can be a long time period of current status of interest rates. But this is not something which is coming as a surprise. It is known to us. So we are in this phase. So this part, how the market has moved from 2020 till 23, what kind of returns we have made, and comparison, vis-a-vis other markets that I have discussed. So what we are saying is that, while, look at this. We touched highs. It took 21 months to once again see that high, but in that phase when, you know, the market was falling, March 23 was such a phase where equity valuations turned quite reasonable again, and we were on the lower end of the neutral phase, and therefore we indicated to investors to start looking at equity from long-term investment perspective and take that as an opportunity to allocate more in hybrid categories, because valuation wise equity was not at the lowest level like what we observed in the lowest level of last 3 years in 2020, but it was somewhere in between reasonably low levels. And debt at that point in time, March beginning, was giving you very high returns, very high in the sense it's best. That means a 10-year government paper was 7.45 at the beginning of March, and AAA corporate paper was 7.85, and double A rated papers were somewhere between 9 to 10. A-rated A plus papers were 11.2 to 12, like that. So we got very good returns, or, you know, reasonably good level of interest income from debt also. And we said that hybrids will make a lot of sense, which will give you combination of both the asset class, equity not very high at that point in time, and debt the best of both the asset classes you were getting, or not the best, but reasonably good level. So equity not at very high valuation, and debt was reasonably good in interest income, at least beating inflation returns that time. But in the last 3 months, what has happened? Equity has once again risen from the lows of March, and debt has fallen from the highs of March. So the debt we have seen at the end of June, the 10-year government paper is 7.1 after falling to close to 7. From 7.45, it went down to 7, and once again it has risen to 7.1. So debt has come off, you know, from highs of March. Highs of March were 7.45. So we are in this situation where, you know, we take into account all the 4 parameters. This yield gap ratio also, you know, I'll discuss in the debt part shortly. But, you know, if I were to tell you at the end of June where we were, so this price to earning multiple, you can see in the note, price to earning, price to book value, market cap to GDP, and yield gap. So price to earning wise, June month we closed at 22.36. Price to book value wise, we were 4.5, and market cap to GDP ratio wise, we were at around 104, because market cap means if we take Sensex companies. So as you know, including last 2 days development, now the market is just very short of, you know, touching small distance, with touching 300 lakh crores market cap. You know, Sensex companies. So it was 296 lakh crores at the end of June, and India's GDP for the last 4 trailing quarters was reported at 270 lakh crores. So if you divide, it would be more than 100 or closer to 100. So at the end of June, we are 104 in market cap to GDP, whereas India's long-term average is around 80. And compared to that, we are higher, but it is also because market cap does not fully reflect the GDP. GDP is also about rural industrial workers, rural laborers, unorganized players, whereas market, we are talking about top 30 companies which are high on you know, cash flows and consistent performance, low on debt, access to capital, best brains, best technology. But GDP is not everything which is reflected in markets. In America and other countries, predominantly their GDP is reflected in the market because there is a big chunk of organized players. So that is not the case with India. So you need to read it with caution. So this is the situation. So we are now, you know, from a very low end of the neutral zone, we are inching up and we are turning towards, you know, the upper band of the neutral zone. So there the strategy recommended is, you know, to go for long-term SIPs and hybrid schemes. that allocate across asset classes to navigate any volatility that may arise due to global growth, inflation dynamics, or due to evolving geopolitical tensions. We don't know, but we continue to remain positive on the factors which are aligned to domestic economy, like banking as a sector, auto, capital goods, manufacturing, pharma, and these sectors are very well represented in our portfolios. So this is the current situation that we are in. About debt, as I told you, participants, are you clear on our outlook? Divakar, is that okay to continue with a small discussion on debt, or you want only equity and maybe I'll talk about a few products?
So I think equity is fine because we'll be running short of time. There's another webinar which will be there in some time. So I think equity is good enough as of now. All
right. So I hope the discussion is clear to all the participants. So what you need to know is that if we talk about Indian markets, valuation. So valuation wise, from a low level that was observed in March 23, we are moving towards the upper band of the neutral zone, where we are saying that we just can't avoid investing in equities because of such good macro situation, and also because of the favorable global factors for India. Like as I mentioned to you, the flows coming to India more now after small time period of movement towards China, where India suffered, and now once again there's disenchantment and there is a de-risking from China that is evident, and also because the China's numbers, if we track, are not that great, not looking great, but in case of India, it's good. And in case of US, it was feared that US would fall into recession after 5% hike, but the data suggests that mixed data it is. Labor market and GDP numbers turned out to be little better than expected. However, manufacturing PMI data shows signs of contraction. So it's a mixed data, and it would be, once the Fed comes out with its statement and on how it is looking at it, we need to hear the Fed governor again and again every month when he comes and analyzes the data. But as far as India is concerned, as you know, we have never been in such a good macro stability environment, where GDP growth prospects are very good. Last year we grew at 7.2. So valuation wise, I've explained. The second angle is business cycle wise or macro factors wise. So all things are favorable. Our fight against inflation is not to that extent as other parts of the world, because we have tamed inflation in the last 3 months, and the southwest monsoon has also been progressing well. So it is very likely that rural inflation will cool off, and rural demand is likely to see a pickup in the second half of this this calendar year. And other than that, all the supply constraints are behind, and if US decides to start investing more, like its IT businesses and all, then all these countries have no better place than India. So inflation dynamics, other deficits, all are under control. Our corporate profitability, Government of India's deficit under control. So our business cycle wise, we can say we are in the middle phase. We are not at the peak, nor are we at the bottom, or it's not just the beginning. We have seen a good pickup in the momentum for that growth, and we are somewhere in the middle phase, and therefore we have a long way to go from middle to top. So that cycle, that business cycle, is just going to flourish further, and market will take cues from the strength of this data point. That we need to remember. So due to the progress in the business cycle, it makes sense to continue investing in equities. However, looking at the way the valuations have moved, and also the fact that still the risk of interest rate hike is not over, the Fed and other central banks may continue hiking, or inflation can still pick up, pace, because that we have seen in case of Bank of Canada and Bank of Australia, who had first muted their interest rate hike, then reduced, and all of a sudden they hiked. So those are uncertainties that we can't avoid. And then the near-term uncertainties, which we call as political uncertainties, like elections and all those things, the market will keep a watch on that. But remember, market gives wealth creation to those investors who stay for long, who are disciplined, and at the same time, market derives cues from the strength of the company's fundamentals and the strong data that company gives. So business cycle wise, it is definitely a point, to stay invested. Sentiment wise, we are in such a good phase. Domestic money remains strong in terms of SIP money. SIP flows continue to remain robust, and foreign flows have been very, very good in the last 3-4 months. So sentiment wise, it is extremely good. And triggers that we need to watch out for, as you all know, the pace of rate hike and all the risk factors that we need to know. So in this scenario, we are saying that choose the funds which give you participation in multi-asset, which give you participation in equity, debt, or even gold or other asset class, multi-asset approach or hybrid approach, which can give you allocation to debt as well. And at the same time, because this will result into good risk adjusted returns and not just returns arising out of only one allocation. So that is one strategy that we are recommending. Second is we are saying choose the funds that give you participation across market cap and sectors. So as I told you, last 3 months we have witnessed all the sectors participating. So it's like India's economic growth story at the forefront and in the spotlight, and that is leading to such a broad-based recovery in the markets. Your mid and small caps along with large caps. So not just one sector, all-round participation in the market, and that is something that we have been recommending for the last 1 year almost, that we need to look at the funds which give us allocation to multi-cap approach, where you get allocation to large cap, mid cap, small cap, you get allocation to multi-asset, debt, equity, gold, or other assets for that matter, and you get allocation to wide variety of sectors, because in this kind of scenario, it is so difficult to predict the winner. Who will win? Whether equity will outpace debt, or debt will outpace gold, or gold will outpace others, that is something we can't say. If you just take the example of 22-23, the previous fiscal, our equity markets have given just -0.6. It remained flat, no returns in 22-23. If you take from 1st April 22 till 31st March 23, and the frontline index return, it remained flat. But if you check for gold, in that phase, gold has delivered 14%. And that return has come only from November 22 onwards, due to demand from central banks, and also due to festive season, and due to America giving an indication that the rates have peaked, and therefore, the dollar would depreciate from there on, and therefore, the metals and commodities had seen a good run, and especially this gold and silver. So that is what we have seen. So difficult to say in 2020. If I tell you this phase, this particular phase, entire 2020, there was just a narrow rally in the mega caps, the top 10 companies only, which rallied. And after 2020 October till March 2022, it was mid and small caps and broad-based recovery, which led to this highs that we have witnessed till October 21. But from there on, again correction, and now again, the broad-based participation. So that has been our story thus far. And let me just take you through a few products that I want to share with you. So if you see, Value Discovery is one such fund, because as you know, in this kind of market, when we are witnessing growth all across, it is so difficult to find value. The cheap stocks, which are quality stocks, it is so difficult to find. And this is one fund, you know, where you get participation in blend of large, mid, small cap. And here there is no demarcation set by SEBI about what percentage should be in large cap, what should be in mid cap, what should be in small cap. One can, in the fund house can invest according to its understanding of valuations that exist in large, mid and small cap, and can be overweight large cap if volatility takes precedence on mid and on growth, and more on mid and small cap if valuations are more favorable, and if you know the growth takes precedence. But overall, you know, in value discovery or in value style, we pick up fundamentally good stocks which are available at low valuations compared to their own historical average, their own intrinsic price, and also compared with you know, their industry standards. So this is the benefit of investing in equities. If there was an investor who had invested at the time of inception of Sensex, from April 79 till date, we have seen 44 years of growth, and 1 lakh rupee invested has grown to become 6.26 crore, generating a CAGR of 15.7%. That is the benefit of investing in equities: long-term growth, dividend income, long-term capital appreciation, and wealth creation, and you become part owners in the business. But remember that growth is not linear. It does not come in a straightforward manner. It comes with its bouts of volatility. So if you buy the right stock by understanding your risk return potential and stay invested according to your goals, you become you know, wealthy investors after a long time of investment. And at least when your goals are in horizon, money will not be a constraint. So we you know, as we have discussed on the outlook of equity, that you know, we remain positive on the business cycle because we are in the middle phase of the business cycle growth. Other parts of the world have slowed down and they are growing at some 2.73. China is likely to see a growth rate of 5 this year, but India has grown at 7.2 last fiscal and is likely to see 7% growth this year as well. However, the world estimates suggest that we will grow at somewhere between 6 to 6.5. But you know, overall, our business cycle prospects continue to remain positive. There are pockets of opportunities with reasonably priced you know, space, and that is the philosophy of value buying across large, mid and small cap. So we need to adopt this strategy in the current market environment, which can give us participation in the blend of large, mid and small cap. That is the strategy that we are intending. And here, you know, there is no clear demarcation, so therefore there is benchmark agnostic approach. It's not that we will buy to the same extent as it is represented in the broader index. It can be different. And obviously, when it comes to stock selection, we understand the business model, valuation, management, all that goes behind stock picking. And basically, you know, that's how we choose. Now, currently, we are overweight on these sectors, as you can see: telecommunication, power, pharma. You know, last fiscal 22-23, if you track the sector-wise returns, all sectors have given results somewhere between 16% to 33%, predominantly all sectors. And there are, you know, outliers also, but predominantly you found returns in this range. But pharma was one sector which posted -11.5, and IT posted -23. So the outperformers of 2020-21 were the laggards of 2022 and 22-23 fiscal. So therefore, you know, valuation wise, it is reasonably priced. It has corrected, and you find that in our you know, space. IT, the prospects are good, valuation is also comfortable, but it depends a lot on the US policies. So once they decide to spend big on IT, if they clear the doubts, then obviously the IT sector will also do well. Currently there is a lot of buzz going around, that the AI related business, and America is very keen on partnering with India, and we know that all the big names of technology sector in US, the CEOs are from Indian origin. We know that. So there's a lot of interconnect between the two biggest democracies of the world. So we are very hopeful of that, but may not immediately, maybe after 4 or 5 months, when Fed give us more clarity and the government also decides to increase the spending. And in India, you see, IT will find its place in, what you call electric vehicles, and, a lot of these mobile manufacturing. A lot of this business has come to India, and therefore there's a lot of IT usage in that. We have allocated money to, pharma overweight, power, telecommunication, oil and gas, and transportation, and other sectors that we are relatively underweight compared to Nifty 500 total return index. So what are the reasons? Why are we bullish on auto sector? Because as you know now, that semiconductor chip shortage or high oil prices era, or other bottlenecks are behind. Interest rates have already peaked, and now going forward it will come down only, and we have seen significant part of the rate hike behind us. So therefore, with this, as we see demand recovery happening, auto sector is likely to do very, very well, because from 2018 till 2022, auto sector has suffered a lot. After the NBFC crisis of 2018, and soon after that there was pandemic and all, and semiconductor chip shortage. Now all that is behind, so we are looking forward to this phase. Pharma I have already explained. In telecommunication space, that now there is increased data usage, and also extensive rollout of 5G, and the way the government has given moratorium to all the telecommunication companies to pay back spectrum and usage fee after some time. It gave the moratorium to these companies, and therefore that has also been very beneficial to the business, and the companies were allowed to increase the tariffs, and since then the sector has been on the spotlight. So our top holdings, you can see these are the names which you can refer to in the fact sheet, and also in the product specific presentation which you can download from iPruTouch app. But I want to just highlight to you, see, these are the rolling returns, but look at this. Someone who had invested in 2004 in this particular fund, because this was started in 2004 and it has completed almost 19 years, because in August 2004 it will be 20-year-old. So in August 19 it will be 19, August 23 it will be 19-year-old. In 19 years, your 10 lakh investment done, if you were patient enough to stay invested for long, it has generated 19.6 CAGR return, and the value of investment is 2.8 CR. And in the same period, Nifty 500 index, against which this is compared, because it's a broad-based index representing large, mid, small on total return basis, the returns generated have just been half of that, 1.4 only. So you can see the approach of ICICI Pru AMC in picking up large, mid, and small based on their valuation, based on their fundamental strength, and the way the fund has responded to this style and the approach of portfolio construction. You can see such big outperformance here. And not just lump sum money, look at SIPs. If someone was doing a 10,000 SIP in this fund from 2004 onwards, so in 10 years, 10,000 multiplied by 12 months in a year means 1,20,000 in a year, and in 10 years it is 12 lakhs. In 20 years it would be 24 lakhs. But to complete 20 years, there are, some 14 months behind. So overall, an investor has invested, spread across 19-year period, slightly lower than 24 lakh. So in 24 lakh, you have to reduce 1 lakh 40,000. So 1,20,000, and then remaining is the SIP investment spread across 19 years. Look at this. That has grown to become 1.3 CR SIP returns and 10,000 SIP. And in the same period, Nifty 500 has generated only 85 lakhs. So you can see now the comparison. So since inception, at the rate of 10,000, 22.6 has been invested, and that has grown to become it's 1.4 CR. That's what I was wondering in the previous slide. Probably it was shown for a month before, and after June month, where mid and small caps have done better than large caps, this is definitely going to be even much better and more than 1.5, I believe. And XIR returns are impressive, more than 17%. So across time periods, if you see the performance, it's superb. And as I'm talking to you also, till that time, I can tell you today's 1 year return was showing in value discovery at almost close to 27%. 3-year return is 32% CAGR. So in last 3 years, you have made 32% CAGR, means your money has doubled if you were an investor in this fund 3 years ago. And compared to that, Nifty 500 and BSE 500 index have generated around 25% on 3-year basis. So our fund has outperformed that on 1-year basis, 3-year basis, and also on 5-year basis. If you check, where our returns are 16.8, this is fantastic and consistent. And this is something that I want to highlight. So this is a product which is under recommendation list. Other than that, that large cap is meant for those who are first time equity investors. The strength of steady, stable, good businesses with proven track record of performance, low debt, high cash flows, best brains working for them, height on technology. Who doesn't want to have them in our portfolio? But it's just that you require huge sums of monies, and that way mutual fund offer, economies of scale, and with small sums of monies, you can be part of the growth story of such good businesses who are the market leaders, and from the universe of top 100 companies, the portfolio is constructed. But here you need to remember those investors whose risk appetite is low, who are probably debt investors or traditional investors. How to bring them to equity? We cannot suddenly tell them to invest in, say, a pure mid-cap oriented or a pure small-cap oriented through SIP. Better ways to bring them in a more conservatively managed and very good quality portfolio-based investment, that is blue chip allocation, which is large-cap oriented funds. So this part on the equity returns, we have already discussed that what is the potential of equity. One can understand in long run how much wealth creation has happened in last 44 years, immense. And if this is already discussed, large caps need to be part of your core portfolio. They are less volatile compared to mid and small cap. They have proven track record with strong fundamentals, and they deliver consistent returns. In our fund, we don't believe in quick buying, selling. We buy and we hold the companies for long time period, and that number is evident if you check the portfolio turnover ratio. That's very low. Portfolio turnover is very low, and there we buy and hold the high conviction picks based on our research, and we follow bottom up approach. So a lot of research goes in picking up the right stocks in the fund to stay for long, and the portfolio turnover ratio is low. And if you see, we build a portfolio in such a way that while stock selection is on the basis of bottom up approach, sector-wise representation in our portfolio remains closely aligned with that of sector representation in the index against which it is benchmarked. So it is basically closer to benchmark, what you call sector alignment, and you will find the beta and standard deviation of the fund closer to that of the benchmark. And this is basically, a fund in the last 1 year, if I showcase the performance. So currently we are overweight on the companies which are in the manufacturing and infrastructure development related businesses, auto, cement, telecommunication, real estate. And the reasons also, you can very well understand, how, the basis of selection of this. Now, a rolling return is also to be seen other than the CAGR return that I have explained, because it tells you that during, say, in this particular 10-year period, investors' experience might be different. He might not have come at the same time, what we are showing in the CAGR. In CAGR, it is point-to-point return and averaging of the return in the holding period. Whereas if an investor had come at a different point in time, probably the experience would have been different. So rolling return actually gives you that understanding that the fund is indeed consistent. So do go through this rolling return as well. Look at the 10,000 SIP wealth creation in blue chip fund. Since inception, the fund has completed 15 years in May 2023. So in 15 years, so in 10 years, 12 lakh at the rate of 10,000 per month. So in 15 years, 18 lakhs, and 1 month, June month has also passed, so 18.1 lakh. So 18.1 lakh investor has invested through 10,000 SIP spread across more than 15 years. And that money has grown to become 58 lakhs now, giving us a return XIRR of 14%. And in that phase, Nifty has generated Nifty 100 total return index around close to 12.9, slightly lower than the fund. And as I'm talking to you, blue chip funds return as on today is 24.5% on 1 year basis. And it is, Nifty, BSE 100 has also given the same, but Nifty 100 is around 22. 3-year basis, our fund has delivered 26% CAGR return. 5-year basis, it is 14%. So consistent, steady, stable businesses. And look at this, in 10 years, your SIP amount is doubled. In 15 years, it is 3 times and almost. And this, you can see, the longer the time you give your money to grow, the better will be your performance. And you can see comparative analysis done with Nifty 100 total return index also. If an investor had chosen to do lump sum investment in 2008 by investing 10 lakh rupees in this fund, that is worth 71.5 lakh at the end of May. And you can imagine in June month and also in next 3-4 days of July, you have seen markets advancing, significantly in June month and also in July month thus far. So this is definitely going to be much, much better. At least I believe the 71.5 would show at least 73, while we'll have to wait for the presentation to come. But this is the situation. And last but not the least, I would also urge you to tell your investors to invest through SIPs in small cap category fund and not lump sum money. SIP would be a very good way to allocate money in small cap companies and mid cap companies, because if India's growth story is going to continue, then pure large cap allocation only will not represent that growth. You need to go to small and mid cap to actually participate in India's growth story. So growth and broad-based story of growth will be seen across sectors, as we are hopeful about the prospects of Indian economy, industry, agriculture, services, all put together. We are very hopeful that, we are going to progress, immensely from the mid-cycle phase of business cycle to the top of the chart. So in that case, small caps and mid caps become multi-bag.
Hi, Jaya, sorry to interrupt you. Hello.
Hi.
Basically, there is another webinar which is lined up, and
Yes,
like
and I'm
we
also
have,
done, Divakar. We have finished,
yeah,
and whatever I wanted to convey, I could cover that up, and I was basically
sure.
uh, you know
So I think
about to thank
we got a
everyone.
great insight from you.
So
Yeah.
I hope that
So
the participants have been able to understand the communication and also the investment strategy. Thank you very much for your participation.
true.
Any questions that you may have on what we have covered thus far, you are free to ask.
Correct. So thank you all. Thank you for like attending this webinar. Would request you to just put your question in the chat box so that we can take it forward because the insight. So all the information in a very well manner Jaya shared with us where to invest, what to invest. SIP, yes, SIP is always a great option wherein we can invest. So money will definitely will go in a disciplined way and a good corpus can be created over the period of time. So for the person who is like who is in earning class, definitely they should start one SIP and that too for the longer tenure because we have seen the returns, the CAGR of 14%. So all those things makes the difference, which is very important. So longer the period will be there in the market, better would be the outcome and the corpus which we can create. Anybody is having any questions? So we have few questions, Jaya, like. So they're asking for the fact sheet, so that will ask our relationship manager to share with them. Yeah, and so there are a few. There are two questions like they're asking for the presentation. So can we share the presentation with our customers, or it is like for the
Yes, yes.
presentation purpose only?
So
We can
presentation,
share
as I
that.
mentioned to you, while I have updated you on the June month development and also thus far, you know, how the markets have shaped up and what factors have contributed to that. Maybe in a day or two, you know, the new release will come and you can definitely get hold of that presentation. But I will also urge you to read both the things parallelly, the presentation and also the representation of our portfolios and the funds that you are interested in the fact sheet, so that you can see what holdings are there, which sectors are we overweight on, which sectors are we underweight on, overall track record of performance vis-a-vis Nifty, vis-a-vis broad index, and also, you know, other details related to performance parameters, risk adjusted returns. So like we could not complete the discussion on small caps. I would urge all of you that to go through that. It is a very good product where, you know, you don't see skewness like large cap is predominant allocation in banking and financials and you know, your oil and gas and technology. Predominantly these three sectors occupy positions, whereas in small caps it is not skewed like you know, based on these three you know, sectors only. It is very well represented by all the sectors, and you get participation in many more sectors which are actually not there in large cap space or mid cap space. The companies in media and, you know, your specialty chemicals and engineering goods and some of these textile related businesses, all those, you know, you will find them in small caps and very well positioned and a portfolio and careful pickup of each stock, you know, with lot of research. So kindly go through that, and it's a very good product to invest. So when you read the presentation, also go through the you know, the fact sheet representation and also you know, the product presentation that you know, our sales team will send that across. Ankita will send that to you. So
Jaya, we
all
have
three
another.
you can
Yeah, we have two
understand.
more. Yeah. Yeah, we have two more questions with us. Like, which is the best performing fund in ICICI? So what I believe over here is like every category has like so as HDFC Securities we have our research team, and in every category there is like funds which is there from ICICI also. So ICICI Blue Chip is the one which we are recommending a lot, which is there in the Blue Chip category. And if the horizon is longer, so definitely small cap category makes the sense. Am I right, Jaya?
Yeah, that's right. For long-term holding, the small caps make a lot of sense, because here not just returns are important. Our portfolio will give you good risk-adjusted returns, because small and mid-cap allocations also have their own set of challenges in volatile times. So better ways SIP, and very good portfolio positioning, representing manufacturing theme, consumption theme, and this what you call the sectors which will benefit with economy opening up. All that is very well represented. Plus you will find some allocation can also be done in large and mid caps based on the SEBI guidelines. You can be 65% in small cap space, and remaining you can deploy in large and mid cap also tactically. So you refer to that also. And the performance varies across time periods. Yeah, Divakar.
Yeah, sorry. So, is our fund house is like looking towards micro cap also? Matlab, is there any fund wherein we have taken exposure in micro cap and all those sector, all those companies?
No, I think as far as my knowledge is concerned, on mutual fund platform, no, but I have heard that there are some fund houses who have launched this micro cap based
Okay, so ICICI as of now, no.
Yeah, so we basically in small cap, there is from companies which have 500 crore to 20,000 crore market cap based on the data released till 31st of May. That space is small cap, and that universe is quite big, because large cap occupy only top 100, mid caps are 150, but small cap universe is big. Then there you can, according to your, the classification, the mid caps will be lower than 500 crores.
Yeah. So we have another question
So
also, like why
I
in
think
ICICI Prudential?
So in some other platforms, I have no idea if it is launched in some other platform, like, we have other business verticals also, other business, like your other than mutual funds. So there, if we have launched, I have no idea. I'm not looking at that.
No,
I'm sorry. But as far as micro cap based launches are concerned, I know that industry has launched, is planning to launch, couple of AMCs, a pure micro cap based fund. So it's a high risk actually fund, because already in small caps you face you require, it's a big universe, and your company selection is very important. So a lot of research is involved, and micro cap with that, even much more deeper research is involved, and right selection of stock would be the key to success, in those kinds of funds. While returns can excite you, but you need to also remember that it will come with a high level of risk. So what should matter to us is not only returns, but risk adjusted returns. So go for the funds which match with your risk taking appetite, and not just get lured by the fact that micro caps are actually the multi cap multi baggers in the in the phase when GDP sees a good run up. They are also, if your stock selection is not correct, you can face the reverse impact also.
Agree. Done. So I think we are done over here, Jaya, and so basically there's like we are running out of time. So I would like to thank everyone who has joined this webinar, and our relationship manager will keep calling you, and they'll be in touch with you for recommending all the options which we are having. So definitely SIP mutual fund is always one of the best option. Kindly start with that or continue with that. And if as and when you grow in your professional life, definitely step up SIP is one suggestion from my end. If you have SIP of 10,000, kindly increase it every year, so that a very good corpus as considering inflation and every other aspect. we can create a good corpus. And thank you, Jaya. Thanks for a detailed presentation with all the information which we would be required, and definitely it will help us to it has given us a good information which will help us to create a good portfolio. So
Thank you
yeah,
very
Jaya,
much.
thank you very much, and thank you all.
So see you again sometime later. Do let us know more requirements.
Sure. Okay, have a great day. Bye everyone.
You too have a great day.